Equity helps you grow your wealth, but fixed income helps you sleep. Fixed income takes all the blows when the equity markets are crumbling. Today we'll discuss about all the fixed income products that exist and how they help you. People often believe that debt instruments do not have any risk involved. There are two types of risk involved. First is the credit risk, the risk in which you are giving money to someone but he might not be able to pay you back. For example, you give your money to your friend for opening a cake shop and the cake shop fails miserably and he is not able to return you your money. This is called credit risk. Now in this case, you cannot do much apart from not calling him to your house parties anymore. The second risk is interest rate risk. Suppose in today's time, everyone around you is borrowing money at the rate of 5%. So you lend money to your friend at 5%. Now, after 2 years, the borrowing rate has increased and everyone is borrowing money at the rate of 8%, which is 3% higher than what you were getting. So for the remaining years of your loan, you will earn basically 3% less than others. This is called interest rate risk. So what are the different types of fixed income instruments? Let's start with G-Secs, which is government securities, and T-bills, treasury bills. This is basically you lending money to the government of India. This particular type of fixed income instrument has very little credit risk. And the reason is, think of it as you lending money to a really rich friend. Even if his business fails, he can just call up his dad, ask for money and then pay you back. The government will always pay your money back and it's not going to run anywhere. Government securities are securities for longer time periods, 5, 10, 20, even 50 years. Even though the credit risk is low, this still involves interest rate risk. For example, you lent money to the government, you bought that bond for 100 rupees and you keep getting 5 rupees every year from the government. Now 3 years later, the government is paying 8% for borrowing money. When there is an instrument available which is earning 8% interest, your instrument which only earns 5% automatically becomes less attractive. This decreases the price of your instrument. So basically, when interest rates increase, the price of your bonds decrease. Treasury bills are instruments in which you are lending to a government but for a much shorter period. For example, 91 days, 182 days or 364 days. Since the time horizon is less, the interest rate risk is also less, and since you're lending to the government, the credit risk is also less. The next option is FDs, fixed deposits. Now, most of you all know how FDs work. You basically lend money to a bank and the bank pays you certain interest on it. Most people believe that the money is completely safe, which is also true till a certain extent. Since FDs have lock-in periods for 5 years, 10 years, it also contains interest rate risk. The longer the lock-in period, the higher would be the interest rate risk. Another option is debt funds. Basically, you give money to a fund manager and that fund manager lends debt to different types of organizations. This has both credit risk and interest rate risk. Some examples of these debt funds are credit risk debt funds. In this, the fund manager lends money to corporates who have some level of credit risk. Why does the fund manager do this? The reason is so that he can earn a higher rate of return than normal debt instruments. Another type of instrument is corporate bond debt funds. In this, the fund manager lends money to corporates rather than the government. Now, since he's lending to corporates and there is a higher credit risk involved as compared to lending it to the governments, these corporate debt funds earn a higher rate of return than the government securities. So the idea on which debt fund you need to choose depends on how much the time horizon of your goal is. For example, if you are looking for a very near-term goal, you would be better off investing in T-bills. If you are saving for a goal which is say 3 years or 4 years away, you would be better off investing in maybe low duration debt funds or medium duration debt funds. The higher the duration of a debt fund, the higher the interest rate risk. And let's say if you have a time horizon of 10 years, 15 years, you have a significant amount of time. You can choose products like credit risk debt fund and corporate debt fund so that you can earn a higher rate of return. So let's understand how equity and fixed income work together. When you are saving for a short-term goal, for example, sending your child abroad for education, let's say there are 3 years to it, you cannot afford to lose your capital. It's about your children's education. So it makes sense you to invest your money in a fixed income product, for example, a low duration debt fund, so that your money increases, but at the same time, your capital is also protected. The second case is when you have a very low risk appetite. Many people cannot digest the volatility of equity markets. So it's okay if you reduce your equity exposure and increase your exposure in debt funds. You need to find that sweet spot where you can maximize your returns and maximize your emotional satisfaction as well. The third case is a tactical case. For example, the equity markets have rallied quite a lot and you think it's a good time to book some profits. It will make sense to sell some of your equity mutual funds and move that money to debt mutual funds and wait for a good correction in the markets to come so that you can again move the money from your debt funds to your equity mutual funds. Basically, when the markets have rallied a lot, you are reducing your exposure to equity markets and saving enough gunpowder which you can use when the markets crash and it's the right time to invest. The fourth case is a conditional case which depends on where you stand in your life. Suppose you are 60 years old, you are almost close to retirement. It really doesn't make sense to have a lot of exposure to equity. If you are 60 and you have 70-80% of your wealth stored in equities, what if the markets crash by 30-40%? That would take a direct hit on your retirement corpus. It would be really weird if you retire at 60. By the time you're 65, the markets crash, and at 65, you suddenly don't have funds for your retirement and you have to start working again. So when you're 60, near retirement, it makes more sense to invest in instruments which preserve your capital, even if it means earning slightly lower return. So based on where the markets are and where you are in your current life, fixed income can be a really useful tool when you combine it with equity. In the next video, we'll discuss how precious metal can be used to help us in our asset allocation. Thanks for listening.